Well, Energy Media readers, we've got a real treat for you today. We're talking to Angus Rodger, who is a senior analyst with Wood Mackenzie based out of Singapore. So welcome to the interview, Angus.
Thank you very much for having me.
Now, what got my attention, Angus, was a press release that was put out by Wood Mackenzie, and it was talking about the energy transition creating uncertainty for oil and gas companies, and that affected how they allocated capital. Could you expand on that a bit?
Sure. So we're talking about uncertainty at a number of different levels here. If you're a small to mid-cap or upstream player, your access to capital in the financial markets is fundamentally being affected because many banks, particularly European banks, are effectively not lending to oil and gas companies or have already signaled a gradual trend away from lending to fossil fuels. Many European banks will no longer fund coal projects. That was sort of the first domino to fall. And then that moved to Canadian oil sands or drilling in the Arctic in very environmentally sensitive areas. And over time, that will then transition to effectively an exit from lending to oil and gas companies. That is at the moment a movement led by European banks. I think US banks are probably a little bit behind on that regard. But what will be interesting to see is how that changes. Now that's for the smaller to mid-cap players. For the very large companies, there's a separate trend which is occurring in the financial markets, which is effectively the stock markets, again led by large institutional investors in Europe, don't seem to just like oil and gas stocks anymore. There's a risk attached to them, which is linked to the energy transition, which is linked to climate change. And we're seeing big institutional investors start to divest from oil and gas stocks. So you've got sort of on one side the financing being affected, on the other side you've got the big institutional investors being affected. Both of them are being affected by the energy transition, and it's a source of concern on both sides. And it's a fascinating thing that's happening.
Now, I find this really interesting because I interviewed your colleague, Ed Raleigh, who one of the lead economists has written about energy transition for Wood Mackenzie. And in his study, the Black Gold, I think it was called, he talked about how between now and 2036, when he forecast peak oil demand, oil consumption was going to be affected first by efficiencies, fuel efficiencies in gas-powered, diesel-powered vehicles, and then electrification of transportation about mid-2020s. Now, what I've seen in the last, say, 6 months, and this really is a recent trend, is the cost of batteries has plummeted. We were talking about, 100 kilowatt an hour batteries maybe showing up in 2029, like late 2020s. And now it appears that Volkswagen's already there, and the big manufacturers are already in either broken that threshold or are very, very close to it. And that seems to be speeding up. Now, these kinds of more rapid technology developments than we had anticipated, we forecast, is that increasing the amount of uncertainty that the oil and gas companies are seeing from investors and from financial institutions?
To a degree, I think they look at the rapid growth of renewables, and obviously there's an opportunity there. Do they want to have a renewables business unit as part of their overall portfolio that sits alongside oil and gas and the refining and their petrochemicals, and they're investing in power, and now they're going to invest in renewables? And we've seen from the European majors those tentative investments in battery units and the EV sector, but they're very, very tentative. It's for the oil and gas majors. For them, gas is the bridge fuel. Gas is the transition fuel. And they talk about gas as every dollar they invest in gas is a dollar invested in the energy transition. So whilst they are looking at this rapid growth of renewables, and they're looking at how fast the cost of batteries and solar has fallen, and you're completely right, it's been a dramatic drop in the cost, and that's going to spur really rapid growth. For them, they're looking at this and going, our core business is still oil and gas. Gas for us is almost the horse that we're backing. We're going to put a little bit of money behind the renewables, but we're not telling our investors that we're going to have a dramatic shift in our business model. We're still oil and gas players.
Now, I want to talk a little bit about the majors, because in Canada, what we would call our majors would be Suncor and CNRL and some of those big oil sands players. And they have very strong balance sheets and very strong free cash flow. And they seem to be able to get all the capital they need at the best rates that are available to them. Is that still the case for the majors outside of Canada?
Yes, so the biggest players still have, I would say, relatively easy access to capital. Um, Increasingly, though, that capital comes with certain ties attached to it. For example, the carbon footprint that the oil and gas majors have, whether it's in Canada or elsewhere, has been a source of concern. So we've seen many of the majors divest some of their Canadian oil assets to the Canadian players because they felt that carbon footprint was too intensive. Now, what I find really, really interesting is it's very easy to say, all the assets which the majors have, which are carbon intensive, they're going to sell, whether it's Canada or elsewhere. But that, to me, is a gross oversimplification. Because if you look at somewhere like US tight oil in the Permian, that is a core asset for many of the majors. Yet the carbon footprint of US tight oil is huge. And when you're not going to see them start divesting that anytime soon. So in that case, what they'll have to do is decarbonize the operation, which is a very similar thing I think the Canadian players are going to have to do over time, maybe not tomorrow, but as they continue to access the financial markets, they will be able to access that capital, but they'll have to show evidence in terms of ESG principles that they're really working hard to decarbonize the footprint of their existing operations. Because if they don't, then access to that capital will either get harder or will get more and more expensive because they'll be seen as a risk in terms of what that carbon cost could end up looking like.
That's very interesting, the ESG principle, because of course that's environment, social, and governance, which is becoming increasingly important to all of the bigger companies. I see that all the time here in Canada over the last 2-3 years. And so what you're saying now is, if I understand this correctly, is that access to capital and cost of capital will be to some extent judged or affected by how good the company is judged to be at ESG?
Yes, so that is already happening with European financial institutions and in their interactions with the European majors. As I said, the US financial sector, I can't speak directly for the Canadian financial sector, is not there yet, but I think it is inevitable that it will come over time. And I'll give you a reason why I feel that, why I'm optimistic that that will happen, is that when my colleagues were recently going around Texas, around the Permian, around the Eagle Ford, talking to industry players, one topic came up in every single conversation they had, and it wasn't fracking, it wasn't prices, it wasn't M&A, it was ESG principles. Now, for that to come up in every single conversation in Texas is fascinating because 12 months ago, that would not have been the case. And when my same number of colleagues are going up to see some of their counterparts in Canada, who are also investigating tight oil and tight gas players, again, it's really coming up in the conversation, ESG principles. How do we adhere to this? So yes, US financial sector might be a bit behind Europe, but actually the conversations going on in boardrooms in Canada and the US is very much focusing on this. And it's really happened really quickly. It's like a 12 months almost step change.
That's interesting. I've spent quite a bit of time in West Texas and talked to some of those, those hard-bitten Texas CEOs. And ESG would be something they'd plink with their six-shooter. Not something they would thought about practicing. So now, another thing that came up in your press release is the M&A activity has changed, the mergers and acquisitions activities. Could you address that, please?
Yep. So what we've seen is since 2014, a very slow, steady decline in M&A activity generally globally on the upstream industry. But what's happened in 2019 has been slightly, or actually significantly more dramatic. The bottom's dropped out the market. We have seen significantly less deals globally around the world. So to give you a sense of the numbers, every year since the start of the century, we've had at least 300 material upstream transactions in a year. This year, we'll be lucky if we hit 200. So a real drop on the level of activity. A couple of things behind that. Most of the oil and gas players have been told by their shareholders to be more fiscally conservative, to kind of keep the capital dry and just focus on shareholder returns. So they're trying to discourage large-scale M&A, and particularly in the US, and particularly in this tight oil patch we're talking about in Texas, when they've gone for these big deals, Occidental Anadarko being one, Parcia Energy a recent one, the stock markets have really not liked it. They've really punished the shares of the buying companies. The message is really clear. We don't want you to do this. We want you to try and prove to us, Q on Q, that you can make money from tight oil, because you haven't really proven that to us so far over the last 5 to 10 years. That's
Well,
what we want. We don't want large-scale M&A, and it's really impacting companies' appetite for these big transactions.
that's fascinating, because there's a myth that's been circulating in the Alberta oil patch for a long time, and kind of stoked by the industry leaders there who want changes in policy. They want more American style policy. They point to Texas and they say, oh, well, look at it, it's booming down there. Well, the only thing that's actually booming is drilling, because they have to drill. They have to continue to replace they have a rapid decline in those tight oil wells, and so they have to replace that supply all the time. But in fact, the industry is in really tough shape, is it not?
Yeah, no, I mean, well, what we're seeing is tight oil in particular at an inflection point where previously it was very much an independent-led industry. You know, your Pioneers, your Conchos, those kind of players. And then we're now transitioning to where the big boys are in town. ExxonMobil, Chevron are industrializing the process and trying to really turn it into an enormous factory. And the level of capital required to do that is enormous. And a lot of the independents don't have that capital. They've already burned through all of the last 5 to 6 years. They're now in a position where, as I said, the shareholders are saying, stop spending so much money. We want you to prove to us you can make money. So we got this inflection point where the independents are under a lot of pressure to prove that their business models can actually work. And then we've got the majors going, well, we can do whatever we want. We've got all this capital. We're going to really go to this big style, which is what the majors can do. They can execute really large projects. So that's an inflection point. And the jury is still out on tight oil in terms of longer term, can it deliver sustained production growth? There are lots of question marks over different technical aspects of it, and many of those questions have yet to be answered.
So can I infer from your earlier comments about the drop off in M&A that a lot of what's going on is the larger companies picking up some of these smaller companies that are stressed, their balance sheets are stressed, they're having trouble gaining access to capital, and that we'll see some of these larger companies grow through that M&A activity, buying up the smaller players as opposed to going out and exploring and developing themselves. Is that a fair comment to make?
Well, yes and no, because here we have a kind of a paradoxical situation. On one side, if you are trying to cut costs and you're a tight oil player, and there's someone in the acreage next to you, you could buy them and then combine the two companies, reduce your costs, and that theoretically would be a way to reduce costs overall because you're bringing more efficiency to your operations. But as I said, that was the normal modus operandi for the last few years in Texas. And right now, the shareholders are basically punishing you if you go out and buy stuff. So they're basically saying you've got to do better with what you already have. So the consolidation argument makes a lot of sense, but at the same time, the shareholders are kind of dissuading them from going down that path.
Right, but I was wondering if the big companies, the majors who don't have to worry about that being punished in the stock market and have lots of capital, if they would pursue that strategy.
Right. So yes, they will, and this is also the interesting point in that, why did Occidental go for Anadarko? Because its share price had fallen quite dramatically. And we're seeing a lot of these tight oil players, their share prices have been hammered. So if you look at it in terms of a corporate valuation perspective, they might look really, really cheap. So yes, if you're one of the big majors, there is an opportunity to consolidate and to cherry pick and to look at the players who are most stressed and make those kind of acquisitions. And when you hear the majors talking on the conference calls, whilst they don't give the green light, they don't give the red light either. They always say, yeah, we're looking at stuff, we're looking at acquisitions in the Permian, we're always keeping our eyes open. So yes, I think in terms of the big moves, it probably will be the majors who kind of sweep up some of the distressed players over time.
So if I could sum up, and this will be my last comment or question, Angus, but if I could sum up, it seems to me that as the energy transition generates more uncertainty in global energy markets, global oil and gas markets, is that favors the larger companies that can deal with uncertainty much better than the smaller ones. And all of that seems to be favor consolidation, and I'm going to look at, if I apply that to the Canadian industry, it looks like there's still a lot of juniors and mid caps out there that are really in tough shape. They've got lots of debt on their balance sheets, and that seems to be maybe that wave of consolidation will hit Canada as well. So is that fair to say more uncertainty equals more consolidation?
Yeah, I mean, there's quite a lot to unpack in what you just said. So there's a lot going on. I think longer term, yes. I think shorter term, if we bring it to like the Canadian oil sands situation, the pressure they're going to come under is that whilst oil and gas, particularly oil demand, is going to be strong for many decades to come, the pressure is going to be on, are you the lowest cost operator? Are you able to, as the kind of the world becomes more Darwinian, it's going to be the lowest cost operator to survive and prosper. And the big question is going to be asked to the Canadian oil sands players is, you have a big carbon footprint and you're relatively expensive. You need to sort out one or both of those to continue to really compete longer term, decade on decade in this oil and gas industry. And there's no reason why they can't do that. But as I said, the last 12 months has seen a big shift in ESG chatter in the oil and gas industry. I think the next sort of 24 months, we'll begin to see people looking to see some actions. And the Canadian oil sands players, along with everyone else, is going to have to step up, undoubtedly.
Angus, thank you very much for doing this. Really appreciate it. And enjoy your day in Singapore. And we'll look forward to our next chat.
My pleasure. Thank you very much.